All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Ryan Kimmel.
Yo, yo.
It's 10 a.m. Pacific time here on May 16th. It's got a little cool right now, but it's been a pretty hot week here in Southern California. So hopefully we get some sun this weekend. That's what I'm hoping for.
Same.
Yeah. It's a pretty busy week on the macro front, but let's get into the where are we for the week here. Let me refresh my spreadsheet. Pretty good week for the S&P, up 5% on the week. One loan sector was negative. That was healthcare, negative 15 basis points here. As of time of recording, your big winner was tech, up almost 7.5%. Consumer discretionary up 7.25%. And then it drops down a little bit. Industrial's up 5.3% on the week. So very good week, very broad, a broad movement from the week. And, we're looking at a positive, I think last week we were talking S&P was almost flat. Now we're looking at S&P up 1.5% on a year-to-date basis. So that rebound, the rebound off the April Liberation Day lows has helped a lot, and positive for the year-to-date on S&P. Looks like Russell 1000 was up almost 5%. Russell 2000 up 4.2%. Growth had a great week, up 6.7%, while the Russell value was up just a hair under 3%. And Nasdaq, accordingly was up almost 7% also. Equal weight dropped down a little bit and was up only, or dropped down a little bit from the market cap weight was up just under 4%. Looks like from the highs, S&P is down 3%, so making a lot of that back there. So good week for the stock market there, Ryan.
Yeah, I mean, risk assets surged to start the week on the U.S.-China trade detente, where they implemented a 90-day pause to allow for negotiations. And I was just looking through the joint statement from the White House and China, and it's like hard to believe they would write something like this, just given what was just like a week ago. I mean, they're talking about the importance of U.S. China trade relations, the value of being interconnected economies. So it's I think a lot of people, a lot of strategists, a lot of market participants are reading this as a game changer in the trade dilemma or dynamic that we've been put through over the last
Yeah,
month and a
I
half.
think I think put through is the right term there. Yes. And I think that, really you look at it, I saw Besant said something like they don't want the decoupling between the US and China, which is certainly, the 145 rate that the US is putting on China basically led to it was basically like there was going to be nothing coming in. So a welcome reprieve here. Obviously it's been a week, so we'll have to see what the next 2 months and 3 weeks give us in terms of whether we actually get something sustainable or not, because it's just like a 90-day delay there.
I thought another interesting thing too was, we look at these real-time recession probability indicators from Polymarket, and following the announcement earlier in the week, we saw the recession odds drop from, they were as high as 66% probability of a US recession in 2025. In I think that was as late as like early May, and those are currently at 36%. So pretty big downgrade in the probability recession.
Yeah, and that kind of flows right into kind of what happened in interest rates on the week. And you had the 10-year up 6 basis points. Most of that, we were up 9 basis points on the 10-year on Monday. So right after the China trade deal news. So that kind of shows you how much people or the bond market at least is thinking, okay, no recession. There was pricing, a pretty good probability of recession there from the bond market. With 10-year up 6 basis points, we're at 444 here as the time of recording. Long bond 490. We did touch like 499. I don't think I ever saw a 5 handle on the long bond this week, but definitely I saw like a 499 spot 3 type yield. So it was pretty close there. 2-year up 8 basis points. We're at 398 on the 2-year. And as you would expect, that led to negative returns across the more traditional sectors of the bond market. The ag was down about a quarter point. U.S. Treasury is down slightly more than that, about 0.3%. Agency mortgages down a quarter point, and then interestingly, the investment grade corporate bonds actually up 25 basis points or so. So, on the backs of a less probability of recession, spreads tighten in a little bit on the investment grade corporate bond side. And then your riskier sectors, your high yield was up almost 80 basis points, bank loans up 60 basis points, just in line with the emerging markets. So, kind of that sentiment we saw across the equity market continued across the riskier sectors of the bond market. Interestingly, like ag's up 2% year to date now. Investment grade corporates, the worst performer, up 1.6. Kind of agency mortgages, high yield bank loans, all in that like 2.25% type range, and EM the best performer, up 2.7%. So everything positive across the board, and in bonds for the on a year to date basis, kind of surprisingly, given the long bonds actually up 30 or up 12 basis points year to date. The 10 years down 13. We shift over to commodities. Commodities were down about 1.6%. The industrial metals industrial metals and livestock were the two positive sectors. A lot of that downward performance in commodities, though, driven by gold. Gold down 4.5%. We're at 31.91 for spot gold as of time of recording. Still up 20% on a year-to-date basis, but down 4.5% on the week. Oil rebounded, so we're at 62.43 for WTI per barrel of crude, up to 2.25% on a week-to-date basis there. Overall, commodities still up 4%, so I guess it's the best performing sector still on a year-to-date basis, given S&P's up 1.5, Ag's up 2, and commodities up 4. So we like to do this 401k challenge on our team to see who has the best performance. And since I'm overweight commodities, I think maybe we'll try to run that on Monday and see how everyone's performance works. It's just a friendly competition between us, nothing serious, of course, but it's just a good time for us to harass each other on our asset allocation. But with that, Ryan, it was a busy week on the macro side of things. It was inflation week, so why don't you hit us with what was going on the macro side?
Yeah, sure. So, as you're saying, we got an update on the inflation front for the month of April this week. We had a series of inflation reports come out, and the main takeaway is that at least prior to the bulk of the impacts from the tariffs feeding through into prices, like the inflation trends were moving in the right direction with I'd say broad-based deceleration. So on Tuesday, we had the CPI report for April, and that came in weaker than expectations. The headline, we saw a 22 basis point month over month gain, below the 30 basis point gain that was expected. Bit of an acceleration from the previous month where we actually had a decline in prices month over month. And that brought the headline year over year change to 2.3, which was the lowest rate since Feb 21. On the core side, which I deem is a bit more important, more less susceptible to the volatility of energy and food prices, that was slightly weaker than expected. Saw the price index move up 24 basis points below the 30 basis points consensus. Bit of an acceleration from the previous month, which we saw, only a 6 basis point gain. And the year over year growth rate was stable at 2.8%, which again was, the slowest rate we've seen since March 21. Kind of looking at near term trends though, you look at 3-month annualized growth rates for core, that decelerated to 2.1. So at least on a kind of a short term window, we were getting closer to the Fed's 2% target. And, a lot of uncertainty on how tariffs are going to impact, core goods prices. But at least before we saw the storm from tariffs, inflation was heading in the right direction. Shelter inflation, just looking at OER, that ticked down to 36 basis points month over month, which is kind of high, but on a year over year basis, decelerating to 4.3%, which again is the slowest rate since Feb 22. So we're continuing to see this slow normalization in shelter inflation back to the pre-pandemic growth rates. Um, and I thought it was interesting if you look at, core services ex shelter, the Fed's super core reading. We saw the year over year print for that drop to 2.7 year over year, which was slowest since March 22. So, the segments of inflation that are more linked to wage growth. And, I would imagine that super core probably be less sensitive to tariffs just because, there's no goods in there. That is moving lower. Then on Thursday, we had PPI for April, and that showed that producer prices had an outright decline of 47 basis points on the month, just based on the final demand reading. Consensus was expecting a 20 basis point increase. So pretty significant decline there, unexpected decline. New year-over-year rate decelerated a full 1% to 2.4%. Looking at the core reading, that was softer as well. That declined 11 basis points month over month, with the year-over-year of core PPI. And again, this is ex food, energy, and trade, which are the more volatile components. That declined to 2.9. And we also had import prices this morning, just focusing on the inflation data first. And that came in a little bit hotter than expected on the headline. But when you look through the components that feed into the PCE number, the PCE price index, which the Fed followed more closely, those were a bit softer. So, when you tie together the CPI, the PPI, and the import prices, it's looking like PCE and more importantly core PCE um, for the month of April is going to be another softish print. And economists now are modeling that we could see the headline PC number drop to 2.2% year over year, and the core PC number, which this is kind of the key metric that Fed follows for inflation, that might drop to anywhere between 2.5 to 2.6. So again, we were heading in the right direction prior to tariffs. But this, if the Fed does deem tariffs to be quote unquote transitory, I kind of, put this as a feather in the cap for them to at least to be comfortable to be holding policy where it is right now, at least as they go through kind of the uncertainty that we'll face in the coming months. I'd also highlight, we got an update on some consumption data for April. We had retail sales, and I'd say that this report was kind of mixed on the margin. We saw kind of a pullback in goods consumption, with, the control group, which is the segment of retail sales that's used to calculate kind of PC goods and GDP, that declined 20 basis points, but that's what I would deem is like a look as a give back from the very strong month-over-month readings that we saw in March and February. So it does seem like consumers were kind of front running the tariffs, loading up on spending on goods in Feb and March, and then we saw kind of a give back in April. On the positive side, though, the services oriented sectors like restaurants and bars, that actually showed a pretty strong reading for April. So we're not really seeing what I would deem as like a significant slowdown in consumption just yet. So that negative sentiment data, which we also got an update from the University of Michigan consumer sentiment this morning. They they released their preliminary survey for May, and I mean that was showing consumer sentiment is like near the lowest it gets. It's like at the depths of the global financial crisis, which is pretty hard to imagine. I'd say that the one caveat with this report is that the survey was taken before I think the survey period was between April
I show
22nd.
it ended on May 13th. Yeah.
Yeah, May 13th. So it probably is not capturing any of the US China trade detente that we saw. So it'll be interesting to see what happens with the final release that we'll get towards the end of the month, with sentiment. Also like the inflation expectations are off the charts. Like literally 1 year ahead inflation expectations, those surge up to 7.3 for the month, which would be the highest reading since the early 80s. And in the long run, inflation expectations climbed to 4.6%. And I've highlighted this in the past, but like there is a significant divergence between these consumer inflation expectations and like market-based inflation expectations. So if you look at like 1 year inflation swaps, like those are only at 3.2%. So like less than half of what the sentiment expectations are. And then like 5 and 10 year inflation swaps, those are 2.3 to 2.4. So I am taking the consumer expectations data with a major grain of salt right now.
Yep.
Yep. Well, that wraps it up, Jeff, for me. I don't know if you have any more comments on the eco front.
No, I think it's always good to get that inflation data out of our way and gets rid of a little bit of a volatility point. And seems like the Fed is as you said, kind of if they were not if we didn't have this unknown tariff effects, the Fed would probably be pretty happy with the trend at least and kind of the way things are moving from an inflation standpoint. With that, you can kind of see though, with the unknowns going on, I think we would have had more cuts priced into the market if we were, because the Fed was cutting what they cut 100 basis points last year. There'd probably be at least a higher probability of a cut here in the next meeting, which is June 18th. But given all the unknowns, we're at like a 9% chance of a cut in June, 35% chance of a cut in July. We don't even get a full over 100% chance of a cut until October. And we're down to 2 cuts in 2025. So obviously that comes down as we progress throughout the year, as we're talking about on the trading desk. When you look at recession probabilities, every single day gets you closer to the end of 2025. So that recession probability should be ticking down every single day. Everything else being equal.
Totally. And these Fed cut expectations have really reversed since I think as like late as late April, where I think at one point market was pricing in 4 cuts from the Fed for 2025, and now that's, as you said, just halved to 2 cuts now expected.
And I saw that Bostic out of the Atlanta Fed said he's on, or what he knows now. He said he's on the 1 cut this year camp. So certainly seems like the Fed is going to be on hold, sit on their hands, and kind of wait and see what happens. With that, we did, as I kind of teased last week, topic of the week here, we got a message from Rich. He said his main question is, when do we get yield curve control? What happens when the 30-year, he says, when it happens, the 30-year will be the greatest trade of the century. I don't know about that part, but I know that Sam Lau and I did way back on episode 144 on December 8th of 2023. We talked about yield curve control. Basically, one of the Fed has kind of 3 monetary tools. One is their overnight rate. One is through asset purchases using quantitative easing. And then also they could do, I guess the way we kind of broke it out was quantitative easing. They were saying we're going to buy X dollars of treasuries or agency mortgages, depending on the case. Yield curve control, they will say, okay, we're going to buy every, say they want the 10-year at 2%. They would say, okay, we're going to buy anything above 2%. We're going to buy to keep the cap of yields at 2%. So that's kind of yield curve control versus saying like, we're just going to buy X dollars and kind of spread it out across the curve, kind of pro rata with the issuance size. This is more of it's definitely a yield target. It's the way the Fed could, certainly they control the short-term rates with their overnight funding rate, with their target rate. The 2-year moves, kind of in lockstep with that target rate. This is the way for the Fed to kind of control the longer, potentially control the longer end of the curve. And I think that this is something that people are worried about because as, the deficit continues to balloon, interest payments continue to be a much larger and larger piece of the deficit. One way for that the interest, in the deficit to come under control would be to kind of lower long-term interest rates. And how do you do that other than like you can cause a recession? That would lower long-term interest rates, but that doesn't seem like a healthy way to control the deficit there. So yield curve control is another way to do it. The Bank of Japan enacted it in 2016, and they kind of um, they gave it up there in the kind of end of 2013, which is why Sam and I were talking about it way back then. But I know Ryan, you did a lot of work on yield curve control that the U.S. did in the 1940s. So you want to just I'll give you like an isolation move, and you can talk about that. Kind of an overview on that and how it worked, and whether it was something that people deemed successful or not.
Yeah, so just, quick history lesson, I guess. So we'll keep it brief. You probably talk about this for like an hour or so, but probably lose half our audience. But yeah, so the Fed employed yield curve control back in the 1940s in response to essentially help fund the war effort, World War II. Very similar to today. During the 1940s, we had, debt to GDP levels of, well over 100%. And, the Treasury essentially tapped the Fed and said, hey, you need to cap interest rates across the curve to keep our interest rate or interest expense down. And the way they employed that was pretty interesting. So they embarked on it in 1942, and they held the policy in place until 1951, and they capped the short-term rates, so 3-month rates at 3/8 of a percent, and the 10-year part of the curve at 2.5%. And they were successful in maintaining these caps. The 10-year didn't move above 2.5% during this entire period. And I think what's interesting is that since they kept the front end pegged at 3/8, they really didn't have to buy any long-term bonds, because I guess the steepness of the curve, basically, bond investors were like, well, I trust that they're going to maintain this cap, so I might as well select, the 10-year to me is just as safe as the 3-month with, a 2.5 yield versus a 3/8 yield. So I'm just going to buy the 10-year. So the Fed really didn't have to um, get involved in the long end. But on the front end, though, it's interesting. At one point, the Fed nearly owned the entire stock of outstanding T-bills. So, we think like what the Fed has done since the global financial crisis is being crazy, but it was even wilder during the 1940s. What I think is interesting, um, a key difference between now and then is that the dollar was pegged to gold, 35 bucks an ounce, and exchange rates were pegged to the dollar through the Bretton Woods system. So, nominal exchange rates didn't change. So obviously we have, free floating currencies these days. So, it'd be interesting if, the Fed does embark on some sort of yield curve control, what would happen to the dollar. And, obviously the dollar is not in a, does not operate in a vacuum. It depends on what's going on in other countries and what other central banks are doing. Um, but you would imagine that that could have negative impacts on the dollar. We did see, when the Bank of Japan started employing yield curve control in 2016, um, the yen kind of held in there up until 22, when, the Fed and the ECB started to hike rates in response to high inflation. And then you saw yen sell off, precipitously. So I think it'll be, that is like almost a more important question. You know, yeah, the 30-year would probably rally when yield curve control is deployed, but like, what does that mean for currencies? I think that's a pretty open question because it's very different from what we had going on in the 1940s.
Yeah, and I think that if you look at the chart there that I'm sure Jason's going to throw up on the X, you can see that when the yen really moved right when the 10-year JGB yields kind of were at their cap, right? So like you had that pressure on up the yields, and the Bank of Japan had to come in and kind of actually enforce that cap, and that really seemed like that was really when the yen took off. And then they had to increase their cap, and then it hit the cap right away again, and then it finally kind of gave up the ghost there.
Yeah.
And so that's usually what happens, right? When the market goes, okay, we're going to test your fortitude, or the Fed's fortitude in this case. They would test the Fed's fortitude, and then they'd give up. The Fed would have to kind of manage that process, and then the market tested again and tested again, and that's that's the kind of free market side of things, and test to see how much. Whether the Fed would, as you mentioned, the Fed back buying almost all of the T-bills, the Bank of Japan, was buying so many of their 10-year JGBs that really wasn't like a free market rate. And so, I thought it was interesting that when we were doing QE, one of the rationales behind why the Fed was buying agency mortgages was that they didn't want to be owning all of the treasuries. And so that was kind of a way for them to kind of actually help them kind of hold down the kind of longer term rates, was buying agency mortgages, because those are kind of priced off the 10-year part of the curve. And so, I think that could be another similar scenario that we get there. Now, to Rich's question, when, who knows on that? It's certainly a topic that I know Mr. Gunlock brought it up on post FOMC meeting. What was that, a couple weeks ago? And so it's certainly a topic out there, and something that people will keep an eye on. And if we hear more, I'm sure we'll talk about it here on the Minutes podcast. With that, things to keep an eye on. Looks like a very short, quiet week, or it's not a short week, but it is the week before Memorial Day. We get LEI on Monday. Estimate is negative 0.9. It was a negative 0.2 last month. We have a negative 0.6 rolling off. So that would bring LEI down to negative 3.8. Obviously, we get jobless claims next week. Kind of steady as she goes is the estimate there. And then we get some preliminary S&P Global Manufacturing and Services PMI data. Manufacturing looks to dip below 50 to 49.8. So that's looks like Kimbrough says we had 4 consecutive prints above 50. Guess we'll break that streak if we get that 49.8. Services expected to expand to 51.1 from 50.8. So kind of the same trend that we've been seeing with services carrying the weight there against the manufacturing side of things. But I think that's a pretty quiet week there. And hopefully we get a little bit of low vol and a little respite from all the craziness that's going on.
Yes, thank you all our listeners out there today on DL Minutes. Hit us up on X at DL Minutes, or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yeah, we'll get to some of those other questions we got on our email there. So thank you, Rich, for that question. Make sure you can find more information about DoubleLine at our website, doubleline.com. YouTube channel is youtube.com/doubleline capital. We have a Ken Shinoda Bloomberg TV appearance. We have Jeff Sherman on the UBS Fixed Income podcast. 3-minute short commodity interview that I did on Yahoo Finance. So always a lot of content out there on our YouTube channel. So thanks for tuning in. Hope everyone has a great weekend.
Thanks, everyone.